Good afternoon, everybody. Welcome to the Nest Egg Builder Show. I am Kathy Scalzo. I am filling in for Peggy today. And so today we have Elijah Randall speaking he's filling in for Patrick Grimes, actually, who is supposed to be speaking with us. But Elijah is the investor relations specialist. So prior to joining Passive Investing Mastery, Elijah owned a residential construction company where he led the rehabilitation of more than 2,000 single-family homes and pioneered innovative estimating software enhancing industry efficiency. Elijah has personally invested in over 60 single-family flips and rentals, demonstrating a deep understanding of market dynamics. With a strong relationship with Patrick spanning over 25 years, he has brought his 15 years of experience in real estate and customer support into commercial real estate and alternative assets. Elijah has established himself as a seasoned professional with a keen eye for smart investments and a commitment to outstanding investor relations. So thank you for joining us, Elijah, and go ahead and take it away.
Absolutely. I'll go ahead and share my screen. Okay. Is everyone able to see that right there?
No, we don't see it. Oh, there we go. It's coming.
Okay, good. It came up. Great. So what we're dealing with in the market, obviously, is both challenging but also opportunistic. And so hopefully at the end of this conversation, we can have some hope in alternatives. And I think some of you are here for that. Obviously, the concept of winning from the upside of downturns is not just a clever name. There's a lot of opportunity that can be had. So when we go through this, we'll talk about in a moment really what we'll be going through. And I'll introduce Patrick as well. He's the CEO of Passive Investing Mastery and really has had a heart for not only the standard investing in what you would typically understand to be alternatives, but in also crafting the best-in-class type of investments so that other investors like yourselves can invest alongside. The mission of Passive Investing Mastery is really to help investors to be the masters of their own passive investing in alternatives. And we actually do a biweekly mastery series with a kind of a blue ocean effect on different alternatives. There's a disclaimer that we probably need to go through. Any type of investment, obviously, there's a risk of loss. And furthermore, we're not financial advisors or legal or tax professionals, so this shouldn't be seen as financial, legal, or tax advice. So this will be what we'll talk about. This is Patrick, the CEO of Passive Investing Mastery, and what we'll go through is why alternative investments, especially compared to traditional, maybe more traditional like you'd be used to seeing, how the wealthy diversify and how you can have a healthy portfolio in your investments. The idea sometimes is to really master having cash flow freedom or freedom in your financial freedom. And I think there's also, to add to that, would be financial security. And one way to do that is to see a diversification in your portfolio. Typical investor progression. We'll talk about how Patrick did it real quick, some of how I did it, and then also we'll go into probably maybe where you might find yourself in the mix of progressing in your alternative journey and investing passively into great sponsored deals. The introduction to non-traditional investments in general is sort of the focus point here, but winning from the upside of the downturn that you've been seeing and why some of those traditional investments may be a bit more volatile. And then the high and low correlation, we can explain that. So correlation is just simply said, it's what does or does not correlate to any individual market. So speaking of the stock market, for instance, if the stock market is up, are there other investments that don't correlate with that up and down volatility of the stock market and so on? So I obviously am filling in for Patrick, but he's the CEO and founder of Passive Investing Mastery. And since 2007, he's been investing in alternatives. There's a little bit that we'll go into, but overall, he's acquired um, over 600 million in his portfolio assets under management and raised over 50 million. The extras is really his giving back to the community, and that's why we do the Mastery series. This is why um, this webinar takes place, I'm sure, is for educational purposes and to really help investors to see what's out there and what's available. He's a #1 bestseller, two books actually now that he has, and there's a great track record of his education as well. With this, we'll kind of rush through this, but the thing I want to focus on is I've known Patrick for 30 years. He was in my wedding. We went to high school together. There's just been a strong bond. And when he was getting into real estate in particular in the beginning, after the downturn that happened in 2008 and 9, he was looking to reinvest back into real estate and wanted to get into some single family homes. And that's what I was doing quite heavily, actually. So I helped him with his single family home investments. And through that process, he really did develop not just an understanding of one particular market, but realized and started, in fact, even to a degree with other investors and other sponsors in his network. He was kind of trading other alternatives that were available at the time and becoming very passionate about understanding what was available to an investor and how they could diversify their portfolio. The books we talked about and where he's investing, we've sort of mentioned here, but it's good to take a look at the story and his background if you want. There's even a free book link I can put in the chat at the end. So what we're doing and what we're working on and really where we feel like the market is right now and why we're doing what we're doing, the acquisitions and lending is what we're focusing on right now. We see that not just the volatility of the market, but some of the downturn specifically in the real estate market has brought about an opportunity. For some, it may be something that they're concerned with because they're just treading water at this point. We'll talk through that. But there's also an ability to take advantage more opportunistically in times like this, just like we saw after the financial banking collapse in 2008 and 9. There's a chance right now with interest rates rising and with some of the commercial market having a significant dip that you can see opportunistic alternative asset investment opportunities. Income fund, acquisitions fund, litigation portfolio. We'll touch on those briefly, just as why we see them both for their opportunistic reality right now, but as well the non-correlated reality, something that doesn't rise and fall with the stock market or with other markets right now that tend to be a bit more volatile. Some of the track record we can discuss about recessionary income fund. The recessionary income fund in general is lending on commercial real estate. This is small balance commercial cash flowing assets. And as you know, the commercial industry took a hit. And so what is happening is that not only did that market take a hit, but there's a lot of lenders that were lending on that type of real estate that are pencils down, or they've held back, or they've pushed out their underwriting, making it more difficult sometimes for owners and operators to be able to get in there on a particular opportunity. So being able to have private lending, just like what we saw, especially in the single family space after the banking collapse in 2008 and 9, there's an opportunity again with over $1.5 trillion amount of commercial debt coming due this year. A lot of the regional banks or some of the more traditional financing is that they're a bit timid. And so being able to come in at some really strong rates can be very opportunistic. And so we've created an income fund where we're lending on current values, not after repair values, but current values in commercial real estate after the dip. And it's low loan to value, 65% and under. Right now we're averaging 57, 58%, as you see. we have a diversification understanding to help protect the downside. So instead of being on a single note or trying to bombard the fund with a lot of potentially more risky opportunities, even in single family, we'd instead focus on commercial real estate that if we had to take it back, we'd want to focus in areas that we'd be okay to take the asset, and we want to keep the cushion of low loan to value. So currently, right now, there's a couple different ways that we structured it. One with a short-term fixed interest, and then one with a longer-term equity share play, where the member equity of anything that comes in above the note holders and the preferred return gets split with the longer-term shareholders in the fund. We believe that that is really the way that we craft it is that now it's more of a best-in-class opportunity, and investors can see that with opportunity, they can actually also win. The acquisitions fund, this is a unique to the commercial space in any kind of fund structure that we've seen. Instead of a value add play right now, we're actually recognizing that the industry itself, and we'll talk briefly about it, but the commercial industry it's a bit hard to say when the rebound is going to happen. We know it's going to happen, but knowing when it's going to happen is sometimes a bit of a struggle. And this is quite possibly one of the better, maybe the best commercial buying opportunity of our lifetime. And so being able to take advantage, but also not necessarily have to stay long term in the value add strategy, which worked some years ago, a few years ago, being able to change the strategy to be able to get the upside of the downturn, making the money on the buy. We'll talk about that in a moment as well. But we're in quite a few assets now in this, and had for a while because of the success of the fund itself. We weren't taking new capital. We'll see that we're going to be taking new capital soon. But the point is that when you strategize with an opportunity, it's there for you. When these times happen where there's a little bit of a lull or there's a little bit of a dip, then you can see the opportunistic opportunity there. This is our team. We have the benefit with each fund of having an expert partner in everything that we do, ones that have been participating in that particular market for 15 years plus on the acquisitions fund, the income fund, and one we'll talk briefly about that's really non-correlated, the litigation funding lending. We'll go through that. Overall, the accessibility of our team is always there, and so we really do. Patrick's always got as a core value to kind of give back with that education and to make sure that we have time to be able to discuss with investors one-on-one, not just the opportunities to where they may be comfortable, but to also see what they've been investing in and possibly where their portfolio itself may need some diversity. Why alternative investments? I know we had Nick. He was talking through some of the traditional volatility on the market. I'm glad you brought that up. I wanted to discuss alternatives are really important for you being able to lay your head down at night and not worry about what the particular market's doing, what the stock market's doing, individually, even maybe where gold price is or where oil is. But in general, even oil is an alternative asset that has a place in a portfolio, but oil and gas. What we want to know sometimes is when to time the market. And sometimes the answer is not trying to time the market, right? Because that's almost impossible to do. So it's really in times of volatility, we see it more where folks are trying to time things correctly. But if you get into a diversified portfolio and you're in alternative assets that are asset backed, then you can really have downside protection from volatility. One thing to note is that 14 Fed rate hikes cycles, 11 of the last 14 have ended in a bust or have created some kind of economic volatility. And we've just seen a new rate hike that has happened, and it doesn't seem like there's as much pressure right now to reduce it the way that they were originally thinking. So it's a great time to consider alternatives that help balance out portfolio. Specifically, in balancing from traditional to alternatives, you can see that in bear markets in particular, alternatives really outperform. And so that speaks to the non-correlated elements sometimes, but then also with the asset-backed concept of all of the alternatives that are out there, and each one individually has its own set of risks. We decide to participate in the ones we do based on wanting to be in a particular market, carving out the what we consider to be the best in class in that. Patrick has a great way of not simply taking an opportunity that comes across his desk and seeing what to do about it, but instead seeing a market that he wants to get into in an opportunistic way, and then choosing the right who, and then taking time to decide what the best strategy would be to not only have downside protection, but also to expose yourself and your portfolio and investing toward a greater upside with real reasonable and strong returns. In times of rising rate environments in particular, you can see how alternative investments really shine even more than they typically do. And this is a time that we're seeing ourselves in now. But mostly the reducing the dependence on any of the traditional assets and their volatility is what can help keep you financially secure while aiming toward financial independence. One good way to look at investing is to see what the wealthy are doing or the ultra wealthy are doing. And in particular, diversity plays a huge role in the wealthy's diversification. When you see this chart that we pulled up here for you, there is allocations that you see, some in stocks, mutual funds, trusts, some in miscellaneous, maybe cash equivalents, and then in business equity and other real estate. You can see the big portion there of that investment portfolio with the ultra wealthy being in those categories. So when you're looking into alternatives, yeah, it's a matter of seeing what's out there, what possibly you may want to get into, but more importantly, what your portfolio may need to diversify into to be more balanced. So allocating beyond stocks and even real estate, when you consider real estate being a big portion of what we just saw in the chunk of almost 50% of where the ultra wealthy invest, there's another amount in private equity, and this can be other alternatives that we'll discuss. But non-correlated investments, they have cycles, and the idea of non-correlated means that the cycles don't relate to each other. Other way of saying it is that you can hedge with different types of alternatives so that when not everything is up at the same time, but also not everything is down at the same time. And one thing that we see investors doing a lot is that when they get comfortable with a particular asset or they know a lot about it, specifically in real estate, this happens, that they become accidentally over allocated and over indexed in that particular alternative asset. So when folks come to us often, we ask them where they're investing, what type of investments they have, and it's easy to see when folks are looking at other alternatives, one of their first things that they typically say is, well, I don't know anything about that. So part of the education that is being brought in this webinar and that we try to do on a regular basis is to get folks to be more comfortable. We don't ever want anybody to invest until they're comfortable in something, but those that take the time to get comfortable and prioritize understanding what's happening in other alternatives, especially in opportunistic times, can be a great help in balancing of your portfolio. The ruse of REITs. Patrick wrote an article on this in Forbes that was published, and really there's a few things to talk about, but we won't spend a lot of time here. In the financial planning world, there is a certain amount of investments that are available for them to be able to not only offer but make a portion on when they're helping folks with their portfolio. REITs is one of those that tends to be more readily available, but it really lacks the benefits of real property or the asset-backed reality. Sometimes it is mistaken for real property diversification, but you don't get to benefit from some of the tax advantages, say, of real estate, like depreciation, the concept of the direct hedge against inflation, or the security of hard assets is something to significantly consider. Overall, REITs tend to behave a bit more like stocks. And so they're subject not only to market volatility, but the sentiment of the market, which also brings a lot of that volatility. When you compare real estate investment trust, that's what REIT stands for, the S&P 500 stock market exchange and real property, you can see um, here, real property tends to be more steady than REITs and the stock market. So this is just to show how it does tend to correlate a bit more with that sentiment as opposed to the real assets backed investing. Alternative investment options. One of the reasons why we do the Mastery series, and I'm so glad that you all are doing the educational presentations here, is because what typically the reason typically investors we find don't invest in alternatives is not because they wouldn't, but because they don't know much about it. And because there is quite a few different opportunities, it is good to avail yourself of that education to continue to watch these webinars. Like I said, Patrick does a biweekly mastery series as well. Those are not all opportunities that we're choosing to invest in, but in the blue ocean of alternatives, and then having the strong language around, and this is why we've chosen what we've chosen, really does resonate with a lot of investors. Gold investments, this is one of those alternatives that's typically inversely correlated to stocks. So as stocks tend to go up, gold may level out or go down and vice versa. If stocks tend to trend downward, then gold tends to go up. So it's a non-correlated investment, but it doesn't tend to stay as solidly upticking as some others. You do have, though, the safe haven asset effect here that you are seeing a cash equivalent that you saw in the ultra wealthy, that there's a place for that in some of those alternative miscellaneous options of your portfolio. When you see gold versus the S&P 500, we already spoke about this, but it does tend to have an inverse correlation, meaning it sometimes does not trend together. Gold versus the dollar has another similar effect, as you can see. Overall, kind of knowing aspects of alternatives and their correlation can be helpful. But when you balance your portfolio, the benefit is that you know that you have more security because of that balance. Oil and gas investments, as we mentioned before, not only because of sometimes the tax benefits here, but in the right opportunities, there could be a place in the portfolio. It has a low correlation with stocks, which can be great. So it provides a hedge. There's diverse investment options, and we won't go into all of those now. Some folks call it like upstream, midstream, downstream. There's a concept of long-term cash flow if you're getting into royalties. There's higher risk, but some tax advantages if you're getting into drilling. Overall, we're not promoting that investment right now, but when you get into it, if there is a diversification play, it can be helpful. So you don't just win big or lose big in any type of investment, because it does tend to be a higher risk. When you see gold and oil and gas, here's an example of some of the volatility, but also the concept, just speaking again to the different correlations with different investments. Do they correlate? Yeah, typically gold and oil do correlate together in more than 80% of the time. When you consider the cash flow potential of oil and gas, sometimes that can be attractive. When you consider the more safe haven of gold, that can also be attractive. So just knowing sort of how much to put into a portfolio at any time is key, and balancing out. One thing that we should talk about first here is acquisitions. With the commercial industry being at really an amazing buying opportunity, it's good to know what types of assets are currently part of that grouping. It's not maybe all commercial. There's some multifamily that is available, and there's some that the equity's not there based on some previous loans that are now in some cases being restructured. So what we've decided is not just doing the short-term holds as the opportunistic win from this downturn so that we can make the money on the buy, but we're also focusing a bit more on mid-sized commercial. We'll talk about that. When you learn about any alternative based on trends, it's great to see some of the history so you can know and learn from it. We, based on when Patrick in 2007, when he got into pre-development, which he does not do at all anymore, he bet big on that. And then with the downturn of the banking system in 2008 and 9 and that real estate downturn, he lost big. And so one of the ways that you can get into real estate and also protect the downside is by getting into existing construction that's cash flowing. When it's cash flowing, then you're not ground up construction. So this isn't against ground up construction. Just one of our values at Passive Investing Mastery is that we want to be a part of existing construction that's cash flowing so that you have, and then you can get low leverage on that property so you have a cushion. Also investing in those rate caps and fixed interest rates so that you know the peak of what can be coming against you in the future with potential interest rate hikes. And the value add rent growth was something that happened 3 years ago and before that was doing great. That's not what we're focusing on now though, because as interest rates go up, valuations go down. The value of the property goes down especially if you're not on a fixed interest. But even if you are, there's typically a downturn that can happen in that particular market. So during this downturn, we feel like there are some indicators of why the short-term holds are key. So inflation increased. Yes, rents can go up when inflation increases, and this can be a win for the commercial industry, but so does maintenance costs, so do renovation costs, so does labor and materials. So even though you can win as inflation may go up with rents, you also, if you're renovating on a value add play, that can also go against you. And sometimes there's availability issues. There was after COVID. There might be coming soon with some of the tariffs that we're seeing possibly coming around the horizon. And so it's important to note that as costs go up, that can change some of the fundamentals in the underwriting of a particular deal. The income that can also be hit by not just inflation or interest rates, but as you probably know, some of the key areas to buy commercial real estate, South, Midwest, Southeast, some of those areas got hit with insurance premiums going up, property taxes going up, and as we know with the interest rates going up, that can also affect some of the long-term plays in that particular asset class. Not to mention what I just talked about with COVID, coming out of that with delinquency skyrocketing and folks not paying for their own bill as the government was. There was a backlog in evictions, and it also brought a lot of assistance needed in that, and that took a hit in the market, and that's partly what contributed to the downturn. So overall, with those challenges of timelines of construction, costs of construction, potential material delays, backlogged evictions that caused some of the downturn, and possibly rents going flat now, we believe in taking advantage of the opportunity now with a short-term acquisitions play. So when you're thinking about any market, it's good to follow not just what some of the trends are, but those that have really invested heavily, like Warren Buffett. And he's famously known for saying, be fearful when others are greedy and be greedy when others are fearful. This is, if you take the concept of greed out of it, the concept is when to act. And right now, when commercial real estate was taking a dip, it was a time to actually consider how to carve out a best-in-class type of allocation in that market. And that's why we decided, since we don't have the crystal ball of where the real estate market is going to be in its rebound, we decided to invest differently. One of the ways that we chose to do that is with the acquisitions fund, and that is if we can't tell exactly when the value is going to come back for our value add play, but we can know that we can make money on the buy now, we decided to focus on that. So when you make your money on the buy, not the sell. This is true in any investment, whether it's real estate business or the stock market. I think the value add strategy will recover for sure, and those that are doing it now may do well, but we're focusing in terms of a strategy that we believe makes the upside of this current situation that we're in, and it doesn't look like it's going away anytime soon. So being able to make it while it's available is important. So the strategy of the acquisitions fund for us, and this may be something just to consider in alternatives in general, when you're carving out a new strategy, we're deciding to compound the investments. So instead of bringing a ton of cash flow out in the beginning or ongoing, we're taking those assets, we're buying them cash from the fund, and then we're trading forward. So one becomes two, two becomes four, four become eight, and so on. And we're backfilling the investment that we paid with cash from the fund with low leverage debt, um, and maybe 50% so that we could then trade forward into other assets. And then the timeline of those sale events, 12, 14 months. That's that short term concept. And we're really dealing with owners and operators that need to move on or want to move on in these mid-sized commercial properties. Maybe there isn't as much opportunity with that in multifamily, but we're seeing it heavy in industrial. We're seeing it heavy in retail centers. There's some prime opportunities where 500,000 up to 7 million on these properties is able to be taken down quickly, and we're more favorable as an offer, even though we're not the highest offer, because we're able to bring cash from the funds. So we're using our funds that way. We think it's wise right now to do that. It is a cash flowing investment because each one of these properties is stable. We're choosing not to do the value add strategy because of the things we mentioned before. So in light of that, that means that the property is just something that was distressed, not because the property itself was distressed, but because the owners are in distress. They need capital, or they need to move on. A lot of opportunities we've seen is inherited properties where in their inheritance they didn't really want to operate the property, they didn't want to manage it, or they didn't know how to do it well. So we're able to come in and quickly stabilize it and get it ready for sale. This is what we talked about with the direct to owner outreach. We we have a process of how we find these leads, how we find the direct owners, and then we strategically take them down quickly. Most of our assets, once we get through the due diligence, we close within 2 weeks, and that's only possible right now because of the really high velocity of being able to use cash from the fund. There's other alternatives though, and we can get into just a few more here as we go through it. Some of these may be lesser known. When you think about different industries that tend to steadily climb, that don't tend to be volatile at all, you think maybe about healthcare. Everyone, when they get sick, they need a doctor. Doesn't matter if it's COVID, doesn't matter what's going on in the stock market, education, utilities. But something you might not have thought about is also legal services. And we'll talk about that and how we've carved out an amazing opportunity there as well in this particular market. But thinking in terms of alternatives that don't just inversely correlate, but are also not volatile. They're non-correlated assets, meaning that they tend to steadily climb over time because they don't care about what's going on with interest rates. Those types of investments don't care about what's happening with the gold price, with elections, with oil and gas, with tariffs, and so on. Why investors like legal services? This has actually been an industry that has been mostly reserved to those that could come in at a very high minimum. So we're really happy that we were able to partner with someone who's been in the industry for a very long time and semi-retired from a huge fund and was able to help us carve out an opportunity that comes direct to the accredited investor. So it's now available to get into where once hedge funds and sovereign funds and institutional finance were the only ones who could really get in it, $20 million minimums. Now we're able to lend to law firms, as we'll describe shortly, and have a strong downside protection with a good strategy. But this particular market in general is a steady climbing market. You see it in the green. It's now advanced the especially the tort industry, the mass tort industry. This isn't class action lawsuits or ambulance chasing of any kind, but the civil suit mass tort industry is something that has been steadily climbing to where it's almost as big now as the global airline industry, if you can imagine that. And that is what we mean when we talk about some of these lesser known, non-correlated alternatives like education and like the medical industry and so on. You always need, in utilities, you always need a plumber. Regardless of what's going on, you always need a doctor, and the people are getting educated. Third party legal funding. Mass tort, I talked about just briefly. We won't go into it much, but there's a difference between class action, which maybe some of you have even experienced, getting a small check in the mail from a class action lawsuit, where a single case with a bunch of claimants joined together and they all had to split whatever the settlement was. The mass tort industry is different in that it takes individual cases and they stay individual claimants who had a harm done to them, and they just simply get consolidated into one big case called a mass tort case. Commercial litigation, personal injury, and so on. You can see that industry and how it actually segmented into some of the bigger economies around the globe. In the US, it's very, very big part of our economy. You can see that chart right there. So when speaking about it, the overview is that when you're thinking about winning from a downturn and you're thinking about balancing your portfolio and you're thinking also, as you should, about not necessarily participating always in volatile markets, it's good to see recession resilience. It's good to see a strategy, especially that can uh, pay out quickly and that has a lot of historical. Really, this is as steady as the U.S. judicial system, and that just trucks along, as mentioned. It doesn't care about interest rates, doesn't care about what's going on in the stock market or elections and so on. And really, when it can be carved out to an individual investor like yourself, it's an amazing play. So then you don't have to have a $20 million buy-in or $10 million buy-in to be able to participate. In general, these cases are late staged and they're well known. Yeah, some of these, as listed here, you probably even heard about. You might have seen some of the ads come across TV. There's specialized marketing that happens that law firms do to be able to attract those that have been harmed. And when we talk about late stage, which we'll show a chart in a second of what that could look like, what that means is that two of the main features of protecting the claimant on a particular case to be able to bring in more claimants to it and having that vision of what the settlement is probably going to be looking like and when it's starting to come to a close and start to happen is that causality and liability have already been proven and handled in that particular case. So as you see, Camp Lejeune, water contamination, the Marines and their families, really the heroes of our country, suffered greatly. 3M firefighter foam, again, our firefighters struggling with effects of that which was spoken to the FDA fraudulently, as though it was good, it was safe enough to even eat, and that was not the case. And you see others like Roundup Weed Killer. I'm sure you've probably seen some of the ads across with that, where the salt of the earth, the farmers, agricultural industry was harmed. So when you think about real estate, how it is able to bring in opportunity where housing can be affordable, or in retail where business can come to your area and it provides an opportunity for the markets and economy. This is actually providing access to justice where folks wouldn't otherwise be able to afford fighting a big defendant, someone who caused harm on a really wide scale basis. The expert partner, as we mentioned, Patrick, starts with the who and then carves out a strategy and then looks at the opportunities available in the market, which is great because then we know when to say yes and we know when to say no. I think that's a real strong play for any time that you're working with a sponsor, to know that they don't have a full incentive to just say yes to everything, but that they're able to know what their buy box is or what their strategy is so that they can stay consistent in what they were intending to do from the beginning and they can continue to execute. This particular reason why we even have access to deliver it to the individual investor is because uh, David Guzman, our expert partner on the litigation funding portfolio, in it for 16 years. He was in a fund that was over $500 million. And after that downturn we talked about in 2008 and 9, he helped recover $25 billion for the taxpayer on those loans that were fraudulently mishandled after the banking collapse. Going through it briefly, and then we can do some Q&A and we can answer some questions, whatever you all may have. It's what we talked about just now, enabling access to justice. It's solving needs in the legal industry. But what it is at its core is that we're lending to law firms that have existing claimants, what they call an existing docket of high value claimants on these big cases that we want to participate in. And they may want to use the capital to bring in new claimants to really, since they're working on that case anyway, it doesn't cost them as much per claimant at that point to be able to continue forward. So they love the idea of increasing their docket. And it also helps be more dangerous against these defendants that have caused the harm. So they tend to settle quicker when that activity is happening. Sometimes too, because as you probably know, a lot of law firms, the lawyers get paid by the hour, but the only way to bring this access to these claimants that have been harmed is to not charge them up front, but to only get paid on a contingency fee basis. So with that in mind, these cases can take a while to get to settlement. So it's important to note that if they've invested, now they have equity in those claimants. And just like on a real estate investment where there's an appraiser that appraises the value of and uses comparables in the area to determine value and uses the cap rate to determine value, there are litigation valuation specialists. And just like a lien would be put on a real estate property, there's in the fund that we do, we put a UCC1 filing lien on the law firm's assets to have collateral of those claimants as they come in or if they're already existing. So speaking again of sort of how it connects to real estate, there's another strong connection, and that is that when you're considering that collateral cushion, loan to value with commercial real estate in particular, we've seen how important that was to not be too high loan to value with a small cushion, because as that real estate commercial valuation started to dip, got a lot of folks in trouble and refining was less possible. So in this case, we're staying under 30%. Right now it's between 20 and 30% loan to value, which brings a significant cushion for downside protection. We're also requiring a version of skin in the game. So it's either that they have the existing docket, they have the time in that particular case, or just like you might do on a value add commercial property where you pay a little toward construction and then you have it inspected and then you pay more. It's very similar in the marketing strategy with legal funding. If we're advancing funds toward that marketing, then we pay a little toward the marketing. We see those qualified claimants come in, and then we pay a little bit more for more marketing. The strategy matters. It's not just who you know, like David Guzman and his entire network of law firms and cases, but it's also carving out the strategy that makes the most sense to be able to, in a quick fashion, get reasonable returns with a strong downside protection. So where we show up here, though there is potentially more to be made if you got on the early stage, just like there might be more to be made if you started in pre-development or ground up development, Patrick has learned his lesson from that and is not wanting to participate. So we're only participating in very late stage cases with what we're doing. And that what that means is what I mentioned before about causality and liability already being handled. It's important to note that that's what's happened already with any of the cases we've been involved in. So that's very late stage. It's very close to settlement, and it's typically pending settlement. So what we're anticipating is starting to see returns in what we're doing within 2 years, starting to see those distributions and participating on those claims, and then ramping up in year 3 and 4, and then maybe a little bit of a fizzling out in year 5. The different types of claimants that we've participated in already
I'm
that are
so-
existing. Go ahead.
we only have 10 minutes left for Q&A.
Yeah, we can do that now. So I'll just leave this up because that's basically what we already talked about. And the return structure we can go through later. They can see it at the last slide with, if they want to click on it just to see what we do, how we do it. If they want to participate in the mastery sessions and series that we have biweekly that Patrick puts on, really great. They could do that as well. And it seems like the screen's frozen up there, but it'll get to there in a moment. Let's go to Q&A right now. Very good. Thank you.
Does anybody have any questions for Elijah? Nobody?
Maybe you can answer this to start. Was this something that you'd already heard of before, or is some of this new to you? Is it a good thing a good reminder? Where are we at?
I'm curious, you may have mentioned it already, but what is the difference between a fund and a syndication?
Well, all these are technically syndications, but because a lot of times syndication gets used synonymously with, say, like a real estate commercial deal, sometimes that word then gets avoided in other types of funds. But anytime that you're pooling capital together on a particular opportunity, that's usually a form of a syndication.
Just so this passive investing mastery, is that for anybody or only for people who choose to invest?
Passive Investing Mastery is for anyone if you want to enjoy the Mastery series and get to know all types of different alternatives that are out there. We have panelists on biweekly that Patrick interviews and hosts. If you are an accredited investor, that means most accredited investors know they are, but some we found don't. If you have $1 million in net worth outside of your personal residence, or if you're single and you make 200,000 or more over the last couple of years, or if with a spouse 300,000, then you're an accredited investor. But those are the investors that we work with that decide to invest with us. You can definitely get a free book. If you just go to passiveinvestingmastery.com/book, then you can get Patrick's bestseller. He's got a chapter in there. It's an amazing read about his story, and you can see all about it. If you want to connect not just investing, but just to see what types of investments there are in some of those return structures, like the acquisitions fund, 30 to 40%, or the income fund, different options between 7 and 14%, and then the legal funding portfolio that we just mentioned, diversified litigation, 20 to 35%. Those are all things that we feel like, with downside protection, have very strong returns. It's why we do what we do, but we're also not just giving back, but one of our core values is to make sure that everyone knows what's out there so that they can make smart decisions to balance their portfolio as needed.
So you said he does the Zoom calls twice a week?
Yeah, particular Zoom, like a webinar fashion of with panelists and a host. It's not twice a week, it's every other week.
Oh, okay.
Yep. And there's quite a few in the queue. If you want to go there, you can simply register and you can have access to dozens that are there already.
Okay. Looks like Christina has a question.
Absolutely.
Hi, great presentation. My
Thanks.
question is, um, once there's an opportunity to seize, what is the first step in strategizing with that opportunity? I guess mindset and way.
Well, that's a really great question. And both Patrick and I have talked about this, and it typically starts with a willingness to pivot. Just like how investors tend to get over indexed in any one particular asset that they're comfortable with, a lot of times sponsors get overconfident in one particular strategy. So the willingness to pivot when there's a market opportunity, and then, like I mentioned, If you're used to just having a deal come across your desk, or that you're used to that strategy, you go after more of the same typically. And especially if you've, in particular, built a brand around a particular strategy, it's sometimes hard to make a pivot or a shift. But with Patrick and having more access to different alternatives, it's easy for us to see when opportunities are starting to happen, because when you see, I shouldn't use this, but it's the only thing coming to my mind. But when you see blood in the streets, it's typically a time to see what's going on, right? What is happening in a particular market and what potential opportunities could be coming from it. That one quote from Warren Buffett, where that be greedy when others are fearful. When you start seeing fear in a market, it doesn't always mean that it's the time to avoid, but it may not mean, at the same time, pointing to your question, it may not mean that you now continue to do the same strategy. So, what I believe, the willingness, number one, and then number two, starting to see why it is struggling and what opportunity there may be. So in this case, when we started seeing interest rates go up, insurance premiums go up, inflation, and we started seeing delays in materials, that meant to us long-term play is probably not the strategy to continue. So we thought short-term. And even though it hadn't been tested as much in commercial as it is in single family homes, for instance, in real estate, we were able to partner with someone who had a long history in acquiring commercial properties, talked about the strategy, and it was obvious. Yeah, that is doable. And so what we did, number three, is we made sure that we grew the fund in proportion to the opportunity. And that's why for a little while here, that fund hasn't been accepting new investment capital, because it's actually been a victim of its own success. It's been able to trade forward the way that it was designed, and we didn't need new capital because we had a sale event or we had more refi events. And the strategy there was to compound the growth forward. And that's another pivot point. Typically, you'd want to share those distributions because they would be attractive to investors. But instead, the idea was make as much advantage in the opportunity while it lasts, because of the short-term structure of that. Another idea, when you see volatility in the market and you have some unknowns, now the pivot would be like to legal funding or to education or utilities or to medical, because now you don't have to invest only in the right time of a particular market, hoping that you catch it at the right moment. Now you can invest in non-correlated investments. So that really opened up the window for us to really seize the opportunity, as you mentioned, to something that was not correlated, that didn't care about interest rates, didn't care about elections, didn't care about potential tariffs or COVID, and so on. So that was another opportunity, right? Find a market with the right who, with the right strategy, that can really have the key fundamentals of what we've always been about, and that's downside protection, upside potential, and having clarity of simplicity on a short term, as short of term as possible, to be able to receive capital back. Sometimes that means monthly cash flow, like in the income fund. And sometimes that means a short window of starting to see strong disbursements in the legal funding. And sometimes that means taking advantage of the acquisitions fund with a 3-year lockup instead of a 5, 6, 7, 8, 10-year plus, with the potential of the value add strategy, which is a bit unknown when some of those will be able to have full cycle. Did that answer your question?
Absolutely. Thank you
Good.
very much.
Yeah.
So how would you suggest someone gets started if they're not an accredited investor?
I love that question. And that's really, we get that question a lot. I think at anytime someone isn't accredited, there's only 3 ways to go about it. One way is that you really make sure that you're improving on who you are as a marketable asset in every networked opportunity you have and in the industry that you pick, because that way you can increase your income typically over time. Instead of sitting back just hoping that your money will work for you when it's maybe not strong enough yet to be able to establish that. If you can become more valuable in the market, you can maybe earn some more income that then you can have more capital to invest. Number two, speaking of that network, when you connect with different sponsor teams, sometimes folks have taken a bit more of an active approach. Now, that's not what I'm recommending right now, but that is one way to do it, where you start with doing some of the grunt work to be able to get to become a part of different opportunities in a more sweat equity type of way. The third is that you can start seeing how your balance is in your portfolio in general, and make sure that you may not be over risking in your portfolio, possibly with a single allocation, since you didn't have enough to invest. So that reason maybe why you're not growing it is because you're risking it all and possibly losing it, or starting to see a fall with it quite often. What happens there sometimes is you can lose that energy that you have in wanting to be an investor in the first place. And that if you get excited about being an investor, I'm telling you, that first channel that I talked about being more marketable in your network and in your profession, you start having more purpose in that when you realize that that bug that bites you in investing, it's not going to go away as long as you start seeing some of the more strategic ways you can invest. Now, again, that's true. You can't maybe always partner with every sponsor that has a great opportunity. That's true. But there are some sponsors that have 506B opportunities, meaning that they don't have to have all accredited investors. They could have some that they get to know before they present the deal. And once they get to know you, then they can offer you some opportunities that are out there. Those may typically be in things like real estate as well. So building your network, not just for the sake of getting yourself out there for opportunities, but also seeing who might be able to do a bit of hand-holding and mentoring with you as you are growing into that path. It's not something that we currently offer, but I know there are a lot of strong sponsors, really good friends of Passive Investing Mastery that do it. And that might be a bit of a market timing thing, but in that case, if you have the tenacity to get out there, you can do it. I suppose there's a fourth way as well, and that's if you wanted to become a financial planner, you can take the Series 65 course and actually become an accredited investor even before you meet it with your income or your net worth. That's not something I'm recommending. It's just another fact that that's a way to actually become an accredited investor as well.
Awesome. Thank you so much for that detailed response. I appreciate that.
Yeah.
Are at the top of the hour, so I'm going to stop the recording, but we can stay on for a few minutes afterwards if anybody has more questions they want to ask off the recording. So
really appreciate the opportunity. I love what you guys are doing.
Yeah, thank you so much for sharing, Elijah. Thank you, everybody, for showing up. And we do this every single Tuesday with a new speaker talking about something else real estate related. So come back and join us again.